Ryan?
Yes.
Yes, Marty.
Okay.
All right. So recording is in progress. We've gone live with the webinar. Folks are coming in. We'll be streaming this to Facebook as well.
Oh, wow. Social media.
Great. Awesome. We've got 20 people join us. Appreciate you all joining. We are about 4 minutes over 8, so I think we can get started. Folks, really appreciate you all taking the time to join us this evening. Today we have Marty joining us. He is our real estate CPA. Started working with Marty last year and have been extremely happy, just blown away. He always takes time to answer my questions, and I have quite a few. So I really appreciate that, Marty. Marty has been working with some of the really large real estate investors here in Cincinnati and outside. And Marty's name was referred to me by some of the whales in real estate investing, if you will. Nate Barger, Mike Ely, Ash Patel, some of the big names. And I'm really glad that we started working with Marty. So Marty, with that, I'm going to pass it over to you if you want to do a quick intro, and then we can dive right into the content.
Certainly. Thank you, Jay. Good evening, everyone. Happy to join you, talk about taxes. That's my life. So, hey, it's one of my favorite things to talk about, especially this time of year as we're heading into a filing season. And it's on everybody's mind. They're thinking about last year. But some of the things we'll talk about could pertain to this upcoming year as well and going forward. So it's never too early to start planning for the next year. It's sometimes with taxation, that's the most important thing, is to plan ahead. It's hard to do planning once the year is over. So to do the planning, you sometimes have to think ahead a year, a couple years, even 5-7 years, particularly with real estate when you're looking at what your exit strategy is going to be and the different avenues for that. So this obviously is not more than an hour presentation and discussion, so we won't get into all of that. We'll touch on some things that hopefully somewhere along the lines here, whatever we talk about will help and benefit you somewhere, or at least make a light bulb go off of something else that you may need to explore a little bit further. As far as for myself, a little background, I've got about 26 years of public accounting CPA experience. A lot of that spent in varying industries, but throughout my tenure, generally I've always worked with real estate clients along the ways, whether it's residential rental properties, commercial rental properties, or even other types of real estate. Most businesses have some real estate component, whether it's a manufacturing facility, wholesaling facility, service facility. There's always real estate. Seems to be a common thread in just about every business that's out there. But so spent pretty much all my time, not all of my time, but the time I've been in public accounting, I've been involved with real estate taxation and some form or aspect of the planning and filing compliance for that. That's pretty much the background. It's been in public accounting, working with, I think as Jay alluded to, some real estate investors. Most recently, I have been working on my own, had my own practice for about the last 7 years, and that practice has had a heavy emphasis on real estate taxation and the individuals that make the investments, whether it's individually or more commonly through partnership or some type of entity structure. So hopefully it gives you a little bit of background about myself. And I think probably at this point, it's time to go ahead and we can get into and start talking about some of these topics that we want to explore here tonight. So first thing I want to kind of talk about is the depreciation. Now, I'm not going to get in, I've got depreciation rules there, but we're not getting into and going to talk about all of the rules with that. Most of this presentation has kind of been put together. If you were doing what we do, CPE, continuing professional education, it's more like a mid-level type CPE course, whereas hopefully you've got some basic understanding about these rules, and we're not doing the basics, what is depreciation or what is another, anything I'm talking about it. We're not going to be talking about like, what is this? Hopefully, when we talk about it, what we're talking about. And so what I'll get into is some of the nuances with that or changes that may be on the way. So like we talk about depreciation and depreciation that you claim, I'm sure most people are familiar, we've heard the term bonus depreciation, which is essentially the ability to write off the cost of an asset that has a life of 20 years or less immediately, or as I'll get into in a minute, 80% of it for 2023, as opposed to having to depreciate that asset and recover the cost over the life of that asset, whether it's a 5-year life, 7-year life, what have you. This bonus depreciation rule was put in actually over 10 years ago, and it's one of those things that has stuck around. It keeps getting sunsetted, and yet it's so popular and it's kind of become addictive, so to speak, to taxpayers that Congress continues to find ways to introduce new laws and bring this back and revive it in some form. It's currently under the most recent extension that happened a couple of years ago. It is scheduled to sunset in a few years. It had been 100%. This in 2023, it's 80%. 2024, it's scheduled to go to 60%. All that means is that's the percent that you can write off of that asset in the initial year. The remaining gets depreciated over whatever the life is. Now, I have a note here about potential tax legislation to follow. A couple of days ago, it was announced that Congress, both Republicans and Democrats, have come to an agreement on extending certain tax provisions. And now there's no legislation drafted yet, but this is kind of what they want to accomplish. Now, what they want to accomplish and what they actually accomplish aren't always the same, but it's something to keep an eye on, because one of the things that they're talking about doing is bringing bonus depreciation back to the 100%. So that was put in there in some of their talking points of one of the items that they're focusing on. So at least it's getting the attention. Now I bring that up because the good and the bad of this is it's one of the things that they are talking about making retroactive as well. So and this is nothing new. They've done this with tax laws. It seems like more commonly recently is making retroactive changes. There is a chance, we have to keep an eye on this, but there is a chance at some point in the next couple of months, they may pass a tax legislation that includes making bonus depreciation 100% for last year instead of the 80%. No guarantees, there's been no legislation written, but it's one of those things that keep your ears and eyes open and listening to the news when they talk about these potential tax law changes, or when something gets announced in the news that there is a tax law that's, agreement that's been struck between Congress, they've written it up and it's going to the president for his signature. Keep an eye out and open for that, because that could have a real effect. And the effect it can have as far as for tax compliance and what you're looking at for this year is, being Johnny on the spot and getting your tax return done in 1st of February, you have to do it under the current rules, which could be an 80% bonus depreciation. And the next thing you know, in March, they passed a law that says it's 100% for last year. Then you got to go back and file amended returns. So one of the things you have to think about from a compliance standpoint is, do we file the returns, or do we have to get everything ready and then you sit on there and you wait on your returns before it finalizes? Now, for most of you, if you're using a CPA, hopefully they'll bring that to your attention, or they're going to talk about that as it goes along, because there are other provisions in this potential tax legislation dealing with child tax credits and some other non-real estate items that they're also talking about making retroactive. So it's going to have some impact. So just be aware of that. The other thing I mentioned here is as depreciation, let's say bonus depreciation doesn't get extended and it sunsets or goes out. Well, don't forget that if you have your real estate treated as a trade or business, there is the Section 179 that is available to you as a trade or business, where you can write off the cost of up to 1.1, it's a little over $1.1 million in asset additions, as long up to the amount of the net income that you have for that business. So unlike bonus depreciation, it can't give you a bigger loss, but if you do have income in your activity, it gives you a chance to write off that cost either 100% or to the amount of income and eliminate your income. So if you've got a trade or business, don't forget about that. Bonus depreciation gets all of the attention and is what everybody talks about. But if you're a trade or business, which is essentially operating on a regularly and continuously basis, and that's your main focus, it's not some side job for you or some side rental property for you. If you can qualify it as a trade or business, then you got Section 179 potentially out there available for you as well. We also, in dealing with depreciation, some of the things to make sure you're focusing on and thinking about are your class lives for the assets that you're capitalizing, if it has to be capitalized. One of the things everybody I'm sure has heard about is the cost segregation studies. Cost segregation studies, there are firms out there, companies out there that do the cost seg studies. What the cost seg study can do is essentially find, if you go and buy a building, it can take that cost of that building and break it down into short-lived assets that are less than 20 years, which then gives you the ability to take that bonus depreciation. If it's a building and it's a 27.5 residential or a 39-year commercial property, you're not going to get any write-off of that from just the initial purchase because it's not a 20-year or less life. But if you do a cost seg study, you might be able to pull out some of that and get an immediate write-off under the bonus depreciation, or the 179 if you can get it qualified as the 5 or 7 year or the shorter lived property for that. The cost seg study, there are, like I mentioned, there's firms out there that will do that. You don't have to use a firm. You can do the IRS actually has a cost seg study guide on their website for anybody who wants some monotonous, boring read. You can look that up on the IRS website and get some details about what they look for in a cost seg study. The firms that are out there that do it, they do an engineering study. Those are the ones that are the most audit proof. I won't say completely audit proof, but those are the ones out there. If you're using professionals, the IRS likes those reports. You can actually work all the way down. You get to do cost estimates, or you can use rules of thumbs. The problem with that is you better have some solid foundation for what you're doing and separating out the assets. Otherwise, you are looking at, if the IRS audits you, you have a potential audit risk there of losing that. Another item to remember is what's called qualified improvement property. If you have non-residential real estate rental property, if you have non-residential property, so not the residential rental, but non-residential property, any type of commercial property, any improvements to that building that are not an enlargement or for elevators, escalators, or any structural framework, and you do this after the building's in service, so you buy an existing building and then you go in and you make these improvements, there's a good chance you're going to get to qualify most of that cost, if not all of it, as this qualified improvement property. The benefit of that is going to be 15-year property, and then that type of property is going to qualify you for that bonus or the 179. What you want to avoid or make sure you're paying attention to, because if you do that and you make those improvements, you don't want to go and classify and say, well, that's a building improvement, it's a commercial property, so that's a 39-year property. I've seen that where people just capitalize it as 39-year property, and that's not the case. If it's this qualified improvement property, which is the name for it, then you can actually get that to a 15-year property. and get the shorter life for that. And talking about the improvements, there's repair regulations that are out there that came out probably going on just about 10 years now. I think it was around 2015 or so, 2016 maybe, somewhere in that time. These repair regulations made they're really taxpayer friendly. It's still, a lot of people don't understand how friendly they were, or that, you know, these changes were made through Treasury, through their interpretation of what a repair is versus what a capital improvement is. So when you're thinking about this, it's repairs aren't just, you know, replacing a handle on a sink or a faucet, or, you know, fixing a board that's broken. Repairs can be, you have to look at it as, you kind of think about it in terms of the term I have there is Are you refreshing it? Are you renewing it? You know, are you keeping the property in the same state that it was in before? So, for example, one of those examples would be you have a wall that's painted, and you know, just say it's one of the walls of the buildings, and it's got some markings on it, or it's kind of some of the paint's been chipped off, or say it had wallpaper on it and the others were painted, and you want to take that wallpaper off. And so what you're doing is you're just refreshing it. You're putting a fresh coat of paint on it, maybe taking the wallpaper off, putting a fresh coat of paint on it. Well, even if it might cost you, again, the size of the wall and with the cost today, I'm just throwing numbers out there. Let's say it was $5,000 for what you were doing. That doesn't necessarily mean because of that cost you have to capitalize it. It could very well be treated as a repair because of the amount that the work that you're doing in comparison to all of the walls and the structure that's there. Because a lot of this, what they kind of looked at with the repair regulations, is what's called a unit of property. A unit of property, think of it, I've got some examples there. All of your HVAC system is a unit of property. Your plumbing in a building is a unit of property. The electrical is a unit of property. And what the repair regulation said is, if you're replacing or making changes to what's installed, and the cost the work that you're doing isn't more than 30% of the cost of that unit of property, then you've got a repair to that property and not a capital improvement. So, you know, let's say you've got, you think of about a hotel, and, you know, you've got, you know, 50 to 100 HVAC units on that hotel, and you go and you replace 10 of those HVAC units. You know, that's a repair. That's not a capitalized expense where you got to capitalize the cost of those 10 new HVAC systems, because the cost of that, you just think of it in terms of, you know, if all the costs of all the HVAC systems are the same, and you had 100 on that building, just as an example, and you're replacing 10, you're only replacing 10% of those. So you have a repair. So when you look at this, any type of changes you're making, or repairs or improvements to a property that you have in real estate, think of it in terms of, okay, what is your unit of property that you're dealing with? Is it the building? Is it one of the systems? You know, what are you dealing with? And, you know, in the nature of that cost, how much are you replacing, repairing? What are you doing? And so does it exceed that threshold to have to be capitalized, or, you know, can you under like a refresh or renewal, can you treat it as a repair, or under the 30% rule, can you treat it as a repair? So those are some of the big changes, and got a little bit more lenient with the write-offs. And the other thing that's come along with this, and I mentioned it kind of first there, is there's a de minimis safe harbor election that can be made. You can make this election every year when you file your tax return, whether it's an entity return or personal return. What this allows you to do is, for most people in general, you can write off up to an asset that costs up to $2,500. You make this election and you can immediately expense that. You don't have to capitalize that, even if it is something that would be capitalized. Think of a computer. You might buy a computer for your business that's, you know, $1,500 or $2,000 that you're buying for that. if you make this de minimis safe harbor election, you can write that off because it's below the $2,500 threshold, and the IRS won't challenge that. Now, the other thing with that de minimis safe harbor election is if you're, let's say you're buying, I'm going to use just the computer as the example here, buying 10 computers for $2,000 each in one transaction. That's $20,000. So you think in total, well, that doesn't fall under the safe harbor election to write that off. However, if your receipt shows that it was 10 computers costing $2,000 each, so if you have it individually stated and you can see that price is less than $2,000 for each asset that you're purchasing, that actually qualifies for the de minimis safe harbor election. So keep that in mind. You know, sometimes people will just look at it and look at the receipt in general and say, oh, well, this receipt was for $5,000, you know, for this repair, you know, or this transaction that happened, down my building. So I've got to capitalize that. Well, that's not necessarily the case. If you got a receipt and you had 10 different assets that all cost individually less than that $2,500 limit, then you can expense all of that. So you might get a write-off for that $5,000 or $10,000 expense that you paid instead of capitalizing it and having to depreciate it over potentially a 27.5 or 39-year life. So very important to remember that with the repair regulations out there. Those are some of the big things that affect you from the depreciation standpoint. The other thing I want to point out in planning, some of the things that kind of are traps for individuals or have to keep in mind has to do with the interest expense on real estate. Most real estate, there's a lot of real estate you're usually dealing with where you have debt involved. You know, a building you borrowed money on. Well, watch out because there's the IRS code section, Internal Revenue Code section 263J has a limitation. This was put into effect in 2017. If you're subject to this limitation, you basically cannot deduct interest expense that exceeds 30% of adjusted taxable income. I won't get into the definition of that because there's various adjustments to it, but think of it in terms of it's more or less your taxable income without the interest expense deduction included. So that's a rough ballpark estimate. There are some other tweaks that may be involved with that. For the most part, that's a good estimate for that. That will apply if you are not a small taxpayer. An exclusion exists, and that's average gross receipts less than $29 million. Now, a lot of people I talk to are like, hey, that's great. You know, I'm not above that, so I don't have to worry about this. Well, why do I mention that? Because there is a thing called a tax shelter in tax law, and the definition of a tax shelter in another place of the tax law says you have a tax shelter if greater than 35% of losses are allocated to limited partners or what's called a limited entrepreneurs. Thinking about people who put up money for an investment, but they're silent investors. They're not active in involvement of that activity. So this really is going to apply to your partnership activities for the most part. If you do have, so you have this real estate, and where this can come into play, I see it, you know, happen for individuals or for businesses when they start and they do a real estate entity, and this year they raise money from investors, and we got bonus depreciation, so we get huge write-offs up front, and we've got that. Well, we have to watch out because if you have more than 35% of those losses going to limited partners or limited entrepreneurs from even that first year from all those write-offs, you're classified as a tax shelter basically for this purposes. And what that means is now you have a potential issue with the interest expense deduction on that. Now, how do you get out from that and not have that limitation on the ability to deduct interest expense if you happen to be classified as a tax shelter? And I tell you, that's pretty much for most individuals or most predominant real estate investors. That's what's going to be the hang up. It's not the $29 million in gross receipts. Although if you have a lot of entities that you're involved in or investor in at work, there can be some brother-sister type issues to watch out for. You have to start aggregating, but really it's a tax shelter. And the way to get around that is if you have a real property trade or business. So if you're operating as a business and it's real property, you can elect to be treated as a real property trade or business, and then you don't have a limitation on your interest expense. But the problem with that is you lose the ability to take bonus and accelerated depreciation. You have to go to alternative straight line depreciation calculation. So, you might, on the one hand, hey, you get your interest deduction limit, it's not limited, so you get your full interest deduction, but all of that deduction you take for that bonus, it goes away. So you may be worse off. So it's one of those things you kind of have to watch out for and balance out and think about, okay, if we have this, if it comes into play, which way is better? Because if you make the election to be a real property trade or business, that is permanent. So that not only applies this year, it applies next year and the following year. So you get no bonus depreciation during that lifetime of that, while that election's in effect, basically while that entity's there. So you have to look at it and say, okay, is the loss of all of accelerated depreciation going forward worth it? Or, the interest limitation, do we just take that this first year? Because in future years, if it doesn't disappear permanently, it just gets suspended. So at some point in time, you can either take it in future years against as a deduction, you may qualify, or at the end of the cycle, if you sell it or dispose of that property, it gets added to your basis, and then you can recover it that way. So it's not lost. So those are the things you have to think about and watch out for. These are little traps that they put in there, but you have to make sure you're mindful of that, especially if you're going to be putting together syndicates, a partnership where you're going to bring in investors or limited partners who may get a chunk of the losses for that you can't, that would have to qualify as a limited partner. Now, the last thing I have here is, I talked about that potential legislation that's out there. Well, here's more potential legislation that's out there. One of the things they're talking about doing is doing away with this interest limitation. So it may become a non-issue or a non-issue for a couple of years. They mentioned because of the higher interest rates, they want to give people the ability to deduct more in interest. So we'll see. Sometimes it comes down to numbers, whether they make it a permanent repeal or if they do it for a couple of years. But there is a chance, these things get mentioned, so there's a good chance that if they pass tax legislation, something will come along that affects this deduction in some way, shape, or form. Now I want to move over to operations and some of the things to think about or look at when you're operating. I have individuals who come to me and talk about, they put together this partnership, these investors, and sometimes they want to especially allocate the losses. Maybe they were doing the work, they have the investor put up money, they want to have money going to the money, they want to have losses going to the money investors and move the special allocations around for whatever reason. That's fine if you do it, but it needs to be in writing in the operating agreement. If the operating agreement says basically profits and losses will be allocated in accordance with partnership or ownership, then your accountant should be hand-tied or hand-strung, or when you're doing the partnership return and doing the allocations, you have to go by what's in the partnership agreement. If the IRS comes in and looks at that, and they're going to say, well, you did all these special allocations, but your partnership agreement just says it should be allocated in accordance with the ownership, they're going to change that all around and readjust that. So you just have to have it in writing and make sure everybody agrees, make sure it's in the operating agreement. And I tell people that your operating agreement can be as simple as profits and losses will be allocated in accordance with the what's agreed upon by the partners. Now, so it can be somewhat vague and say you have the ability to do that. If you do that and you do have a special allocation, I would tell you that it really, not for tax purposes, because if you have that in there, we could do it. I would tell you to get it in writing and make sure everybody knows and agrees and signs off on it if you have a special allocation, because you don't want the last thing you want is issue a couple years down the road and somebody says, well, you didn't allocate me all the losses I should have gotten. So it's better to do it when you have everything in writing, have it in front of you. And the other thing you just have to watch out for in any type of special allocation is if there's basis limitations. And you can get basis from debt in a partnership, or if you invest individually and you borrow money, that gives you basis. The issue you have to watch out for is if you have a partnership, is it'll give you basis you have to look at who's the type of debt and who's responsible for the repayment. Because if you have 5 partners and one partner or 2 partners sign the guarantee of repayment of that debt becomes what's called recourse debt for those partners. So they get basis in that debt, but the other partners don't. And if you have losses that exceed the capital accounts, you may have to specially allocate those losses because the partners can't go below 0 in their capital account, and those losses have to be allocated to the partners that have guaranteed that debt. So that gets a little more complicated. There are provisions you can put in place in the operating agreement having to deal with qualified income offsets and allocations that, deficit restoration provisions. You can put those into operating agreements so that if you can basically allocate losses to everybody, even if it exceeds their capital account, as long as there's a obligation to pick up that income at some point later down the line. A lot of operating agreements that attorneys put together generally have those in their boilerplate language, or if not, one of the things you want to look for is looking that they have a section in the operating agreement that refers to the operating agreement capital accounts will be maintained on a 704B basis, which involve some of these things that we've talked about as far as the allocations and when you have these limitations or if you have to do special allocations under tax law because of varying capital account balances. On distributions, when you're in operations with this, what you have to watch out for in distributions or plan for is, as I just talked about, you can have basis in debt, and that'll allow you to deduct losses, even if it exceeds the money you put into it. As long as you're on the hook for that debt, you can deduct those losses. If you bring a new partner in and they assume part of that debt liability, they sign a guarantee and everybody signed a guarantee, so they have assumed part of it, and that reduces your share of debt that you're responsible for. That's actually treated as a distribution to you, and if it exceeds your basis at that point in time after allocating for the debt, you may actually have a surprise income recapture and pick up income on that. So, you got to be careful and watch out for that. You don't want to bring somebody in and then you have your debt shifting, and then at the end of the year, you go and talk to your accountant and you say, okay, here's what's happened. Oh yeah, we added a partner and this, and then they're like, oh no, you've got to pick up $50,000 of income because your share of the liabilities went down, even though you didn't get any cash. That's the way the allocation of the liabilities. So if you've got losses, you've had losses, and you have a negative capital account, and you were using your debt basis for carrying that, be mindful when you're bringing in new partners so that you don't have a sudden income pickup. You might have to do something where you temporarily sign off on that debt until things get right, or there may be some other planning you have to do with that. So again, I'm just trying to help people avoid pitfalls along the way, and things that I've seen over the years that have sometimes tripped people up or caught them off guard, and like in that situation of picking up income when you didn't get any cash, and then you're on the hook for that. You got to come up with some money to pay taxes. Another thing is, I know one thing that is very popular, can be done, and it's fine to do, is you purchase a property, you make improvements to that property, you initially borrow the money, you make improvements to that property, increases the value, and now the bank will loan you more money on that. So maybe it loans you the money, and then you take that money, take a distribution out to the partners, and they want to use that money to make additional investments in other properties or whatever else they want to use it for. The tax law says that interest that you pay on that refinance, if you took it out as a distribution, that's called a debt finance distribution. That money, you need to track the interest that you pay on that interest and report that separately to the partners, or if you're an individual investor, you have to track it individually for yourself, because the deductibility for that interest depends on what you use that money for. If you use it and you buy yourself a sports car or you go buy a boat, well, that becomes personal interest. So that interest is not actually deductible, even though it's on a business or a real estate investment property. It has to be reported separately, and if it's not used for a business or other type of deductible interest, it has to be reported separately, and you don't get the deduction for it. So keep that in mind, that there is that interest tracing. The other things I mentioned here is on the distributions, they can limit your ability to deduct losses, because if you have basis and you make that distribution, that reduces your basis. If that reduces your basis down to zero before you've deducted losses for that year, those losses are suspended because you have no more basis to distribute those, to take that loss deduction. So I've seen people who have been surprised when they think they've got a huge loss coming through, and it turns out they also received a distribution, even if it was a debt finance distribution. That took away their basis. We couldn't get them other basis because they didn't have it wasn't recourse debt to them. And so then their loss got limited for that. And the final note I want to mention on this is individuals are really responsible for tracking their basis under tax law. It's not the entity. A lot of entities will do that, but it's really the individual's ability, or the individual should be tracking that, is responsible for tracking that. So, if you're going to be in an investment and you get 10, 14 years into it, just track it every year, so that if you get to that point, don't rely on the entity to give you your basis, because they may make mistakes or not have it right for you. And so if you're tracking it yourself from the get-go, you're going to know what your basis is and where you're at and what you can deduct. Common thing I've seen, and I think it's very key, or can be beneficial to individuals, especially getting into retirement accounts, or is using retirement accounts to make investments. And this is a great way to get tax-free growth on a property and access funds when you're just getting started. A lot of people maybe leave a corporate world where they had a 401k account built up and they want to roll that into an IRA and use that money to make a real estate investment. That's great. You can do it, get the tax-free growth. Just remember, if you're making an investment, if you do the IRA, you can do that and the IRA, use the money from an IRA to make the real estate investment. It can also borrow money, maybe to buy that, if you need additional funds to buy that property. Just remember that if you borrow money, there's what's called the unrelated business income tax, the UBIT. And what happens is if you have income on that retirement you actually have to pay taxes on that. Your IRA would have to pay taxes on a portion of that that's related to that debt financed acquisition. So there's a few hidden things. And then the other thing, and the thing I tell people, the most important thing with a retirement account is there's a list of prohibited transactions and who's a disqualified person. And these are long lists. It can be related parties and that, but you think about the important things is you are a disqualified person related to your own retirement account. And if you a disqualified person enters into a prohibited transaction with a property that's owned by a retirement type of account, you can run into issues where that money could be subject to immediate taxation and potential penalties. And I'll give you an example. If you had you use an IRA and you bought a rental property down in wherever at a resort, you buy a rental property. You cannot go and use that property. Even if you're paying it, you can't go and use that property. You're a disqualified person. You're not allowed to use that property. Otherwise, that's a prohibited transaction. That's an example. And if by doing that, you basically subjected yourself to immediate taxation and potential penalties, because whatever money was in that retirement account to make that purchase is going to be taxable. And if you haven't hit, for example, at age 59 and a half for an IRA, now you've got an early distribution penalty of 10%, and it may bring on other penalties for substantial understatement or other related when you file your tax return. So very important to remember that. Getting into the reporting, we'll kind of touch upon this. You talk about whether it's material, if your real estate activity, if it's short term, a substantial service provided. The IRS has come out and said hey, that's got to be on a Schedule C instead of a Schedule E. And what that means is it's subject to self-employment tax. Now, you might want that because then you can, if you have losses on that short-term activity, you get it treated as non-passive activity instead of a passive activity. So you got to do your planning around that and what level of activity you have with that. Or as I mentioned, for a partnership or another S corp, the 8825 is a rental property versus Page One, which is an operating entity. So there's planning you could do around that just based on your level of activity or service. You know, we talk about real estate professionals, very important. This is very important that you document your hours. You just have to have more than 750 hours spent in a real estate activity or real estate activities for that year. And more than 50% of your personal services are spent on real estate activity. So if you have another job, you just have to work more hours in your real estate activities than what you spend on the other job or other type of jobs with that. And along with that, you want to make sure that you have material participation. There's a list of 7 different ways you can get material participation, going from spending more than 500 hours in an activity or 100 hours in an activity, and that's more than anybody else in that activity. As long as you've got the material participation, then those activities are going to, qualify as part of this real estate professional. If you file a joint return, your spouse can help you to meet those rules to get a real estate professional. So one spouse can have a full-time job working a W-2. The other spouse can get classified as a real estate professional. So rental properties that you own together or that you have on there in your individual return, you can get that real estate professional designation and get those deductions and write that, if you have losses, get those written off as ordinary. I mentioned there you may need to do a grouping election for that. All that essentially is when you add activities, you bring in a new activity, you want to put them together, and then if you group 2 activities together, you can count the hours spent for both of them in counting whether or not you have material participation. So if you had 5 different activities and you didn't spend, let's say other people were working on it and you didn't spend more than 500 hours, using that as an example, on each of those activities, then you may not meet material participation. But if you take those 5 activities and you can group them, make an irrevocable election to group them, now if you spend 500 hours on those 5 activities, they all 5 activities, you meet the material participation standard. So very important just to keep that in mind when you're looking through your material participation standards, to think about in terms of whether you want to group it or not. If you make the grouping, it's permanent until you dispose of that activity. So once you make the grouping, those groupings stick together, and you can't treat them as whether they're grouped one year or not grouped another year. You've got to keep them together with that. If you treat it as a trade or business, you will get some other deductions. Remember to take advantage of home office deduction, the 199A qualified business income, which gives you the ability to potentially deduct up to 20% of the net income that flows through on that activity from taxation, which is huge. But keep in mind that it may have a downfall on that is the self-employment tax that you potentially may have to pay if it falls on where you have to report it on a Schedule C or Line 1. But do remember that if it's a rental activity, even if you qualify as a real estate professional, if it's a rental activity, that will not be subject to self-employment tax. So make sure you're not putting that in as being subject to self-employment tax. One of the final things I want to kind of go over is talk about 1031s and qualified opportunity funds. These give you the opportunity to defer gains. At 1031, you're just deferring that gain, rolling it over into another like-kind property, so that gain gets deferred permanently. I'm sure a lot of people have heard about that. One of the things people don't really know about is you can start a 1031 exchange and use that to defer the gain to the following tax year. If you enter into that 1031 exchange basically after the 1st of July, as long as you're under the 180 days until January 2nd or January 1st of the following year, you can enter into a 1031 exchange and follow the rules of a 1031 exchange by identifying properties and going through that, and then letting the money sit in that 1031 escrow account until the following year. And then in the following year, if the 1031 falls through or you don't carry through with it and you get the money, at that point in time, you have to pick up the income on that and pick up the gain and report that. So one thing to keep in mind, people don't know about that, but that's actually has, the IRS was okay with that. They went through that situation. If you got big income this year and you want to spread some of that income to next year, and you're selling a property in, say, September, October, November, start the 1031 exchange, let it sit in escrow till January, and then take the money, basically, follow the rules and take the money out of escrow, and you get the money in January, you've deferred that gain reporting until the following year. Final thing is that one thing you can do is in 180 days, you can identify a qualified opportunity fund to roll the money into. That has to do with investments in opportunity zones. There's a lot of funds out there that's set up. You invest in that, and you hold that until 2017. You could defer that gain until that time period. You just have to identify, you have to look at that, because a lot of times in those funds, you're going to be investing that money, you're going to give it to someone else to invest. You don't want to put it in something that they're going to lose your investment and avoid that gain for a few years, and then you get a worse return on that than paying the tax. So you just have to keep that in mind. Look at what you're doing. Finally, thing I want to talk about is on a lot of states. Another good tax planning point that has come in here in the last year or two is a lot of states have enacted, 36 states as of last year, what's called a pass-through entity tax. What this does is if you have an LLC, and some states, I know, like I'm in Kentucky. Kentucky allows single member entities to do this. So if you're in another state and you have a single member LLC, look at it and see, because your state probably has passed this pass-through entity tax, and see if it qualifies for single members. But I do know, for partnerships and other pass-through entities, what they allow you to do is that pass-through entity can make an election to pay the tax, the state tax, on behalf of the owners. And in doing so, the entity is subject to tax and will pay the tax and take the deduction at the entity level, and then a credit flows through to the individuals to take as a deduction. When they report that income on their state return, they then take a deduction on the tax credit to offset that tax liability. So it's really a wash. It's who's paying the tax, and what this does is let the entity do it. What that does is it no longer is an itemized deduction that you have to deduct as a personal tax on your personal return. So if you take the standard deduction, you didn't get a benefit from that anyway. Or if you are able to itemize, remember, you probably know, itemized deductions for taxes are limited to $10,000. Well, this allows you to get unlimited deduction. You don't have to worry about that $10,000 limitation. You may use that up on your real estate taxes, on your personal and other personal taxes that you pay. Well, now you get a deduction for this. So this is a permanent tax savings. So if you're not taking advantage of that, take advantage of that this year when the tax returns are prepared, and make sure that your entity, if you're in these 36 states, that you're having the entity pay that tax and then giving you that statement to claim that credit on your personal return. It's not increasing your tax liability. It's going to give you a permanent tax savings, and that can add up really fast when you start looking at the tax deductions that you're having. When you're subject to, when the rates are 20%, 30%, almost 37.5% for the highest. So let me just see here. Really, that has to do with liquidation. Kind of talked about it. So some things to watch out for. An installment sale. Another planning opportunity that I have talked about with people is if you have a sale and maybe you're doing seller financing for someone, and say you're in December or November, towards the end of the year, you could maybe take that sale and break it up so that they give you half the proceeds now and the other half in January. Well, you might be able to spread that gain between the 2 years. So again, to kind of keep you, if you have other income, ordinary income, into a lower bracket, or keep you out of, if you're in 15% or jumping up to 20%, wherever you might be at, some tax planning might be able to kind of keep your overall tax liability lower by spreading that income between the years. So keep that in mind. Think about being creative when you're entering into transactions, and what you might be able to do with that. So I think we're about 8:53 right now with this, Jay. I know we wanted to have, if there's any questions at the end.
Yeah. No, thank you so much, Marty. This was really good information. I think I'm gonna have to watch it a couple more times to unpack everything. And you've probably invited a few phone calls from me now that you've shared this information. So, but I hope everyone found this information helpful. We've got a few questions here. The first question we have, the first two are kind of related. Actually, they are related to single family or the personal residence, if you will. So are any of these tax benefits applicable to the house that you reside in? And the related question is, if you replace a roof or an HVAC on a single family home, is that treated a capex or a repair?
Good question. As far as on a residential property, if it's not used for the production of income or in a trade or business, what I would tell you to do is you're going to be capitalizing if you're making repairs if you're making these improvements. You're not trying to get it classified as a repair. You want it to be improvement, because what happens is that will get added to your basis. And so when you come to sell that property, the tax law currently has a exclusion as long as you live in a residence for more than 2 years, where you can exclude up to $250,000 gain on a single return or $500,000 on a joint return. Well, with the way prices have gone up recently, in houses, you can get to that $250,000 or $500,000 pretty quickly. So the more basis you have, the higher the sales price you can have. So you kind of have, you're kind of going the reverse argument with that when you talk about repairs, and you want to try and capitalize as much as possible if it's a personal residence, because you're not getting any write-offs. There's no benefit. There's no write-off benefit on a principal residence. And then I think that the second thing you mentioned about the roof, that 30% will apply to that. So you could look at it and say, okay, if you're just if you're putting a new layer of shingles on, what's the cost of that compared to the entire cost of what you would estimate for that roof? Some of this you kind of have to come down to and have documentation for it. But if you're doing that, then you might be able to get that to qualify as a repair. If you're replacing the roof, that brings up a good point. I don't believe I touched upon this, but when you're dealing with a building, if you're replacing it, and the roof is a good example of this. Let's say you're taking the old roof. You bought a property 2 years ago, and now you knew it needed a new roof. You just had to give it a couple of years, get things settled in. You've got the money. You're ready. You want to put a new roof on. With that roof, if you put a new roof on, you have to capitalize the cost of that new roof because you're replacing the whole unit of that property. But in those repair regulations, one of the items that the IRS has added or included is, to the extent that you can allocate a cost basis of what you've already capitalized to the existing roof that is no longer there, you can now write that off, the adjusted basis. So if you take in a couple years of depreciation, you've got that, but you can basically write that off. So a lot of people, there's different ways you can come up with that cost. A lot of people will come up with like the replacement cost example, particularly when you've just purchased the building recently and your purchase price is pretty close to what the replacement cost would be for that. So an example for that would be, you bought a building for $1 million, and you could say, you're 2 years later, you're putting a new roof on that, and it's going to cost you, let's say, $75,000 for the new roof. Well, if it's reasonable through all the numbers you look at, you say, okay, well, $75,000 is what I would have allocated to the roof had I done a component allocation of my original $1 million purchase price. What that allows you to do is you take the new roof, you capitalize it, start depreciation on that at $75,000 this year. Then you take the $75,000 minus a couple of years of depreciation, so you're looking at roughly $73,000 or so for that, depending on the type of asset that it is. That remaining $73,000 basis on the replaced roof that you've now removed, that is not there, you can write that off and take a deduction for that. And that's a good point, because a lot of people, it used to be you had to leave that on there, so you were basically depreciating two roofs until you got rid of that building, because you weren't allowed to do that. But the new regulations, the repair regulations, they allowed you to do it. you got to watch out, because I know I've run across some accountants who are older or don't understand that, or weren't aware of that. And so they put a new roof on there. They just capitalize that and they keep the old building, continue to depreciate it. Well, they missed a write-off opportunity there at that time. Now there's a Form 3115 for accounting method changes, and you can go back in the current year, you can recapture things that should have happened in the prior year and do a catch-up for that. That is another discussion for another day and beyond the scope of this. So it's not lost, but it's something that, hey, you could have had that deduction a couple of years ago, and I'm looking at your return now. So we're going to take that deduction now, but you could have had it and had that tax savings a couple of years ago. So hopefully that answers that question.
Awesome. No, that's really helpful. Nishi and Raj, hope that answers your question. If you have any follow-ups, feel free to type those in as well. We have a couple questions on the real estate professional status. So any suggestions on how to document the 750 hours? And the follow-up question on that is on that same subject, but if you also have a W-2 income in the field of real estate, how does it work? So your W-2 is also real estate. And on top of that, if you want to document your real estate professional status, 750 hours, what are the guidelines around that?
Yeah. Somehow real estate professional always comes out when we talk about this. It's always, a very hot topic, continues to be. And I will say, I mean, it's a hot topic with the IRS as well. They're always looking at this as well. So I'm glad you're asking, or they're asking about documentation, because contemporaneous documentation is very important. I tell my clients who we take a real estate professional classification for, when we discuss that, it's very important to have that documentation. And not, if the IRS is going to look at it, it's going to be 2 years plus after the time you file a return, which is usually the year after that you do you have the activity. So you're talking 2 to 3 years out, and for you to try to remember what you did at that point in time and go back and fill in the blanks, there's not too many people that do it. I know individuals who have great calendars, but not many people can do that. So it's very important to track it. Now, as far as tracking it, it's going to be a method that works for you. It doesn't have to be handwritten. It doesn't have, you can use calendars. The important thing is you're marking down what your activity is. So if you're working on your property, if you're going there and you're spending time working on it, or if you're meeting, with the property, you're actively trying to lease it, you're talking to individuals about that. Just a calendar, some type of tracking of your date. Think of the 5 W's, I believe it is: who, what, when, why, and where. Try and answer those questions as you go through that, so that you have documentation of when that activity occurred, where it occurred, who you were, if you were with somebody, and maybe you're not, but you just want to answer those 5 W's. How much, the time you were spending with that, or the days, if it was multiple days, and what you were doing that was related to that activity that makes it, real estate related activity. So, very, very flexible with documentation, but it's more or less maintaining a calendar, whether it's on your, a calendar you can print off because you've maintained it online, you get electronically record of that, or if you want to go old school and have a piece of paper where you're writing it down and doing it that way. It's just something that's tracking that in the time that you're doing it. So I'm sure, I haven't looked recently. I know there's apps out there for just about everything. So I'm sure there's probably apps out there to track your time as well, when you're spending that time in activity. When you get into as far as W-2 activities, I do know situations where there's real estate agents, you have rental properties and they're a real estate agent. They can get classified by the hours that they're spending with the real estate activity on the rental properties as a real estate agent. If they are getting W-2s, I know a lot of those are 1099s or set up on their own, but it can happen. A lot of times, the real estate professional comes down to facts and circumstances, and so it's the type of activity and how that relates. The one thing you have to watch out for is you may not be able to group that activity with of the W-2 activity with the rental activity, for example, to get your material participation. So you got to make sure that you're meeting the hours that you need to get that material participation so that it can qualify to be part of that. A real estate professional qualifies for that. So you have to watch out for the hours, but you certainly can have W-2 income if that's, because that's treated, the IRS treats W-2 income, a W-2 job, as a trader business. So you're in the trader business of doing that. So then you look at, okay, what kind of activity is that? So you just have to look at what your W-2 activity is, but it could certainly be included in those hours to get you to qualify for that.
Got it. Awesome. Thank you, Marty. I think there's couple more questions, one more related to real estate professional status. And this question comes from Shante. So she's saying, can you go into a little more detail what is meant by material participation for the real estate professional qualification? Do you need to have 500 hours of active ownership? The 750 hours can be 1099 and managing other properties as a property manager, correct? Is the 500 hours separate from the 750 hour requirement? So, Shanti, I don't know if I got that correctly, but if there's anything you would like to add, you can do so by unmuting yourself.
Yeah, to answer the question is the material participation test and the hours, and I use 500 as an example. There's actually 7 tests that are laid out in the regulations about what material participation is. The 500 hours is just one example, but you can actually qualify as material participation with as little as 100 hours if the hours you're spending for that activity are more than any other person that spends time for that activity. So, if you have a maintenance person working on that activity and they're working for you for 50 hours on that activity and you're spending 100 hours, you can still get that to qualify as material participation because of the 100-hour test. What I would tell you to do, I don't want to sit here and go through the 7 tests. I got it in front of me, but there's 7 tests. What I would tell you is if you Google that, do a search on that, material participation, 7 tests, you're going to find that and you're going to see what's laid out. And those are the 7 different ways that you can qualify an activity for material participation and meet that standard. That said, material participation is a complete different standard than real estate professional. Real estate professional, you have to have material participation to qualify for the benefits under real estate professional, but the hours to qualify, they're not the same test, I guess is the easiest way to say that. The 750 hours is being involved in real estate activities, but you also need to meet that material participation test. So you can get to material participation in an activity by, like I said, 100 hours. As little as 100 hours, you can meet material participation. If that's your only real estate activity, though, you likely won't meet the standard. Well, you're not going to meet the standard for 750 hours for a real estate professional. So you could meet the material participation, but not meet the real estate professional standard. So those are separate. And again, material participation, don't fixate on the 500 hours. I use that as an example. That's one of the more common ones that people talk about. I mentioned that because the 100 hours, it's easier to meet that, and you can have more activities to meet that and still seem reasonable. 500 hours, we only have so many hours in a year, and you start putting 500 on top, and then you kind of see how well you can't spend that many hours, and you need to do the grouping election. And that's how you want to bring that up to talk about the grouping election. So they are separate. And the easiest way to see the material participation really is just to Google it, because you're going to find you Google that material participation and 7 tests, it's going to pop up on your first page, probably first if not the first result, of the second result.
Thank you, Marty. And also, I wanted to ask is that act of ownership of property, when you talk about material participation, it has to be something that you actually own?
No, it does not have to be that, although you want, as far as being involved as a real estate professional, you could be managing other properties for other individuals. That may help qualify you as a real estate professional because you're spending that time in real estate activities. So no, you don't have to own it. So it's probably the easiest way just to answer that is you don't have to own it as long if you're involved in an activity. That can get you qualified for the real estate professional hours.
Makes sense. Great. Chante, I hope that answered your question. I think we have one more question from Carlos. Does a partner participating in a JV with self-directed IRA funds have prohibited activities? If so, can you give an example? Because with the
Does a
IRA,
partner
you can't
participating-
manage the LLC and stuff like that. So, yeah.
Yeah, so if you have an IRA and you take that money in the IRA and you invest in a joint venture partnership, so you're a fractional owner of that. I believe, if I understand that correctly, is what we're looking at.
Mhm.
Yes, those rules still apply. So you don't want to run afoul of it. There are a lot of prohibited transactions. I just kind of touched upon the one with, that can be very common with an owner using the property, but that obviously is going to apply. But there are other rules that apply, to related parties, related individuals, and that could be more broad than what you would expect, but on the use of that property. So it's very important if you have that kind of setup to go through those prohibited transaction rules, most likely with a professional or someone dealing with the tax, and checking that. Now, sometimes I have seen a lot of times to do that, you're going to take your IRA and stick it with a firm that manages self-directed IRAs that allow you to make that investment. If you're with a good custodian like that, I have seen where they will have information on that about prohibited transactions. They will provide that information to kind of give you a heads up and kind of, they're not a tax attorney or a tax advisor giving you tax advice, but they do have good information available about those transactions. But if you talk about it with your CPA, they should be able to help you with that and talk through that. About it, it's always good if you have that kind of investment, if you are going to have any type of transaction or involvement with that property that you've invested in through a retirement account, whether it's indirectly or you're the sole investor, check on potential transactions before they occur. And that includes not just yourself, like I said, it can be relatives. You also want to avoid having it, if you go over there and you make repairs and you get paid from that activity, that could be a prohibited transaction. Or anybody that you're related to goes and gets paid, that could be a prohibited transaction. It is a very broad net that they cast, and what they're really trying to do is avoid people abusing this by getting a tax-free way to get their money out of a retirement account into an investment that then they use to pay themselves, and they get access to that money, and they didn't have to take a distribution or to get the money out and then they loan that money to them. They're really trying to avoid people gaming the system essentially with that. So it's very important to watch out for that. And you can also come into, I mentioned that unrelated business income tax with the joint venture. Watch out for if that joint venture creates taxable income. If it's not a rental property, if it's like a hotel, for example, or some other type of commercial operating entity that's not a rental property, that actually, if it has income, your IRA or retirement account will have to pay income taxes on the income that it receives or is allocated to it in excess of $1,000. A lot of traps there. So if my word of wisdom for that, for anybody wanting to use a retirement account to make an investment in property, is explore that with your professional, your tax advisor, before you do it. and make sure you kind of talk about what the transaction is you want to do, and things you might want to do or to watch out for in the traps beforehand, so you know about it, versus making the investment and then you have all these hidden tax traps after the fact. A lot of minefields in that area. It can be very beneficial, but a lot of minefields, so just be careful.
Thank you.
Thank you, Marty. I think those were all the questions we had. I will throw in one question from my side, and that's the last one, and we'll wrap up. A lot of the folks we had today were active investors. There were some passive investors. So passive investors investing as an LP in a syndication, of course, they get a K1 and a paper loss from the depreciation that we do. But at the end, when we sell the property, that does get recaptured if we sell the property at a profit. Is there any way for LPs to defer some of that tax liability? I mean, if they do a 1031 into a tick, sure, but are there any other avenues?
Yeah, and 1031 is kind of hard in that situation because it's really the entity that owns the property has to do the 1031. So
right.
Unless everybody's wanting to do it, you run into those issues, and I think we've discussed that. Excuse me. So limited partners or limited investors, generally on that activity, to the extent they have losses, they're not going to be able to deduct those losses. They're going to carry forward. So the issue that comes in for them is if they have other activities that are passive income and they use those passive losses to offset that income, then they have that issue at the end, right? So really the kind of planning that they have to do is maybe, we talked about it's hard to do that 1031 exchange, but one of the things they may be able to do, as long as we have, if they re-up the bonus depreciation rules, things are changed, maybe we get that legislation. A thing that can happen is, in a transaction like that is maybe they can make another investment into another passive activity, roll those proceeds into that activity, which is going to give them a large deduction in that year. So they're going to have this ordinary income that generates, or they're going to have this income, passive income on this activity from the sale, and they're going to generate that other passive loss on the new activity that'll help offset that. Or if they have other activities that have built up those losses, and that sale transaction, that activity, if it has losses, it frees those up. Or you may have losses in other passive activities that'll free those losses up when that activity gets sold and that comes through. So it's not, you're a little more hand-tied when it comes to limited investors because you also, if you have passive income, you have to use those passive losses. You can't say, I'm going to defer using those losses. I want to carry it forward to have it available to offset my passive income when this activity is disposed of. You have to use it when you have the other income. But there might be some planning that can be done from investments in those other passive activities or some other type of planning activities, and they're beyond the scope of this, where you can make, currently, I throw it out as an example, but an investment in an oil and gas exploration company, they can get almost 100% write-off of your investment in the initial year under current tax law. You might, be able to make an investment in one of those and then get a write-off, and you've got that write-off to help offset that gain that you're making. And again, I throw that out there. I'm not advocating for that, but there's those kind of opportunities that may be out there that are outside of the realm. You just have to be a little more creative or, think about the transaction. And again, that gets back to Jay, what we talked about. One of the first things is doing the planning and not having that sell transaction happen. And then you go to your accountant in March and say, yeah, I sold this. What can we do to reduce my gain or my tax on it? Well, you can't do anything then. If your transaction, most of the time, if somebody's going to sell a property, the investors are going to know a month or a couple of months before. I mean, they're going to be told, hey, we're putting this up for sale. This is coming. Most the syndicators are responsible like that. Like for you, Jay, they're going to go out there and tell them. They're going to be after the fact, oh yeah, we sold this. they're upfront with it. So if you find out about that, that's the key right there. You contact your tax advisor and say, okay, this is coming up. You know, you get the information about what the potential sell might be. So, hey, here's the kind of game we might be looking at. Start thinking about what can we do, and you use that to do your plan before the end of the year. You can't do it in March.
No, that's a really good insight, actually. And this is a question we get very often. So this is definitely helpful. That way you plan your next investment that gives you enough passive loss to offset the capital gains that you made on the first one. So you just keep doing that. This was
Right.
really good
But,
information, Marty.
And Jay, on that, that's what your real estate, you see your real estate investors that are growing their real estate empires, for lack of a better term, their portfolio, growing their portfolio. That's what they're doing is, you know, they're buying a property, taking the losses. That's why they say, you know, they have negative, or they always have a loss, but they're growing their portfolio. Well, they might, you know, grow that for a few years and they're selling it, but they're buying more properties to get those write-offs that offsets their other income. And then they're, you know, growing those in value, sell them, make more money, but they use that and reinvest it. So they're constantly rolling over their gains by taking deductions on the new activities and getting bigger and bigger. So you really don't have to deal with the taxation standpoint or paying taxes until you're ready to, you either level out or you start unwinding your positions, right? So you start reducing your portfolio. And, you know, a lot of times that happens. I've had that happen with some of my real estate clients. They get to 60 and 70 and they're like, okay, you know, I'm ready to get out of the game. I'm ready to start monetizing this and not have everything in real estate. I need some cash, right? Start diversifying a little bit. So they start selling off. Well, at that point they start having taxes. Well, you're going to have the cash because you're reducing the portfolio. You're keeping that cash, so you got the cash to pay the taxes there. But in the interim, for 30 years, you deferred the tax for the most part because you kept rolling it over basically into more and more properties and portfolios.
Awesome. No, this was super helpful. I hope this helps everyone save a few $1,000s on their taxes and avoid some pitfalls that can get you in trouble. So appreciate you sharing all the information, Marty. Last question we have, are you taking new clients?
I am taking new clients, depending on the circumstances. I'm working on bringing additional people on board. We get pretty full here. I'm always happy to talk to individuals and to see if it would be a good fit for us or what we might be able to do for them. I put up there my contact information. That's got my email address if you want to contact me, whether you have additional questions, anything comes to mind after the fact that you wish you had asked, shoot me that, or if you want to have a follow-up, we can certainly have a discussion. I will tell you, for this upcoming season, we are getting close. I mean, we're in January, but we're getting close to being in the heat of tax season already. And my capacity to take on new clients for this year is getting very small and the window shrinking by the day. But that does not mean if we had to defer for a year, you know, we could certainly onboard over the summer and into the fall if need be and get ready for the next season. There's a lot, you know, I like to know a lot about the clients and get background and have those discussions. And it's hard to do that when you're in March trying to onboard somebody when I've got, 250, 300 other returns we're trying to finish up at that same time. So I mentioned that, certainly have a discussion. We can see if it's a fit. Again, it may just be one of the things we have to is either stick for another year, or if you're open to extensions, we do extensions and then we talk about it over the summer and we finish up your filing at that point in time.
Awesome. Great. And you do have clients from other states as well, right? From multiple states outside of Ohio as well?
Yes. Yep. Ohio, Florida, Washington, D.C., California. I mean, the list goes on and on, Colorado. I can work with anybody as long as they approach me. I'm licensed in Ohio and Kentucky. That means basically I can approach people about doing their work. I can solicit them in those states. Outside of that, you have to solicit me to do your work, but I can do it.
Excellent. Great. Thank you so much, Marty. And thank you all for joining. We had a few people drop, but a lot of you stayed on. I hope this information was helpful. The recording will be shared. And thanks again, everyone. Have a great evening. Bye-bye now.
Thank you, everyone. Thanks for having me, Jay. Appreciate it.
No problem. I'll talk to you soon, Marty. See you all.